You filled out the application. You sat in the waiting room. And the finance manager just came back out and said the words you've been waiting to hear. You're approved. That's a great moment. I've watched it happen thousands of times, and it never gets old. But here's what most people don't realize. Getting approved is not the finish line. What happens between that approval and the moment you drive off the lot matters just as much as the approval itself. I'm Gary, the bad credit car guy, 26 years as a general manager of an independent used car dealership. In this video, I'm going to walk you through exactly what happens after you get approved, what the terms mean, what you're signing, what to watch out for, and what you absolutely need to know before you put pen to paper on anything. When the finance manager comes back with an approval, they're going to sit down with you and go over the terms. Let me break down exactly what each of those terms means. First, the amount financed. This is the total dollar amount the lender is willing to loan you. It's based on the vehicle price minus your down payment and trade in equity. This is the number you're paying interest on for the life of the loan. Second, the interest rate. This is your APR, annual percentage rate. In subprime financing, this number is going to be higher than what you'd see advertised on TV. Depending on your credit tier, it could range anywhere from the mid-teens to close to 30%. I'm going to do a dedicated video on interest rates and what they mean for your total cost. But for now, understand that a higher rate means more of each payment goes toward interest and less goes toward your principal balance. Third, the loan term. This is how many months you have to pay the loan back. Common terms in subprime are 36, 48, 60, and 72 months. A longer term means a lower monthly payment, but it also means you pay more interest over the life of the loan. A shorter term means a higher monthly payment, but you pay less total interest and build equity in the vehicle faster. Fourth, your monthly payment. This is the number most people focus on, and while it matters, it's not the only number that matters. Make sure you understand what term that payment is based on and what rate it reflects before you agree to anything. And fifth, stipulations. These are conditions the lender requires before they'll fund your deal. I'll cover those next. Almost every subprime approval comes with stipulations, conditions the lender requires before they release the money to the dealer and finalize your loan. Stips are not a bad thing. They don't mean your approval is in danger. They mean the lender wants to verify a few things before they fund. Here are the most common ones you'll see. Proof of income. This is usually your two most recent pay stubs. If you're paid weekly, they may want 4. If you're self-employed, they may want bank statements. Have these ready before you go to the dealership. It speeds everything up. Proof of residence. Usually a utility bill, bank statement, or piece of official mail with your name and current address on it. It needs to match the address on your application exactly. Proof of insurance. You cannot drive off the lot without full coverage insurance on the vehicle. Liability only is not enough. The lender requires comprehensive and collision coverage because they have a financial interest in that vehicle until you pay off the loan. Get your insurance set up before you go to sign. References. Some subprime lenders require personal references, usually 3 to 5 people with names and phone numbers who can verify your identity. Have these ready. Proof of a working phone. Some lenders want to verify you have a working phone number. A recent phone bill covers this. The more prepared you are with these documents before you go in, the faster your deal funds and the faster you drive home. Now, let's talk about what you're actually signing, because this is where I've seen buyers make the most costly mistakes. And it almost always comes down to signing something they didn't fully understand. There are 2 main documents you need to understand. The first is the buyer's order. This is essentially the bill of sale for the vehicle. It shows the selling price of the car, your down payment, your trade-in allowance and payoff if applicable, any fees, dealer fees, doc fees, title and registration, and the total amount you're financing. Read every line. Make sure the numbers match what you discussed. Make sure there are no fees on there you didn't agree to. If something doesn't look right, ask about it before you sign. The second is the retail installment contract, also called the RIC. This is your actual loan agreement with the lender. It shows your interest rate, your loan term, your monthly payment, your total amount financed, and the total amount you'll pay over the life of the loan, including all interest. That last number, the total amount you'll pay, is the one that surprises most people. On a subprime loan at a high interest rate over a long term, the total you pay back can be significantly more than the price of the vehicle. That's not a trick. That's how interest works. But you need to see that number and understand it before you sign. Read both documents. Ask questions about anything you don't understand. A good finance manager will take the time to explain everything. If someone is rushing you through the signing table and discouraging you from reading what you're signing, that's a problem. After you've gone through the main documents, the finance manager is going to present you with additional products. These are called dealer add-ons or F&I products, finance and insurance products. Let me give you the straight truth on each one. The first is a vehicle service contract, also called an extended warranty. This covers mechanical repairs after the manufacturer's warranty expires. On a used vehicle, especially an older one, this can have real value. But read what it covers carefully. Some service contracts have more exclusions than inclusions. Ask what's covered, what the deductible is, and which repair shops honor it. The second is gap insurance, guaranteed asset protection. This covers the difference between what you owe on your loan and what your vehicle is worth if the car is totaled or stolen. On a subprime loan where you put little money down and you're financing at a high rate, you can quickly find yourself owing more than the car is worth. Gap insurance protects you in that situation. For many subprime buyers, this is worth considering. The third is credit life and disability insurance. This pays off your loan or covers your payments if you die or become disabled. This is almost always overpriced relative to what you'd pay for term life insurance on your own. I'm not going to tell you what to do, but understand what you're paying for it and compare it to what you could get elsewhere. Here's the key thing to understand about all of these products. They get rolled into your loan. That means you pay interest on them for the life of the loan. A $1,500 service contract at 25% APR over 48 months costs you significantly more than $1,500 by the time it's paid off. Only agree to products you actually want and understand, and never feel pressured to take something you don't want. You have the right to say no. Once you've signed everything and driven off the lot, here's what happens next and what you absolutely need to know. The dealer submits your signed contract to the lender. The lender reviews everything, confirms the stips are satisfied, and funds the deal, meaning they send the money to the dealer. This typically happens within 24 to 72 hours of signing. You'll receive a welcome letter or welcome package from the lender in the mail within the first week or two. This will confirm your loan details and tell you exactly when your first payment is due and how to make it. Set up your payment method immediately when that arrives. Don't wait. Now let me be very direct about something. In subprime auto financing, your first payment is the most important payment you will ever make on that loan. Here's why. Subprime lenders watch new accounts very closely in the first 90 days. A missed or late first payment sends an immediate signal to the lender that this deal was a mistake. It can trigger early collection activity. It can affect your ability to get financing in the future. And it can undo every bit of positive credit building this loan could have done for you. Make your first payment on time. Make every payment on time. This loan, paid consistently, is one of the most powerful tools you have for rebuilding your credit. Every on-time payment gets reported to the credit bureaus. Over 12 to 24 months of consistent payments, you will see your score move. And when it's time to refinance or buy your next vehicle, you'll be in a completely different position than you are today. That's the real value of this loan beyond just getting a car. Use it right. Getting approved for a car loan with bad credit is a big deal. Don't let the details at the signing table undo the hard work it took to get there. Read what you sign, understand your terms, know what you're agreeing to, and make that first payment on time. I'm Gary, the bad credit car guy, 26 years in this business. Everything I put out on this channel is real, based on what I've seen happen in real dealerships with real customers. In the next video, I'm going to talk about your interest rate, why subprime rates are as high as they are, what that rate is actually costing you over the life of your loan, and what you can do to get a lower rate when it's time to refinance. That's a video that could save you real money, so make sure you subscribe so you don't miss it. Grab the free guide in the description, The 7 Things Dealers Check Beyond Your Credit Score. Link is right below. Subscribe, leave your questions in the comments, and I'll see you in the next one.